Welcome to Regulatory Ramblings. Our podcast today is brought to you by the University of Hong Kong's RegTech Lab, the HKU Standard Chartered Foundation FinTech Academy, the Asia Global Institute, and the HKU edX Professional Certificate in FinTech, with support from the university's Faculty of Law. I'm your host, Ajay Shamdasani. In our initial spotlight section today, London-based Ian Morrison of search and recruitment firm Arian House and his Hong Kong colleague Raoul Montgomery will be giving us a broader perspective on hiring trends in the legal and compliance space for the remainder of this year and into 2026, with an eye towards global hubs such as London, Hong Kong, and Singapore. Following that, we'll chat with Lotte Schou-Zibell, formerly of the Asian Development Bank, on financial inclusion, sustainability, and how bamboo can help. But first, based in Hong Kong and London, Arian House is a top provider of executive search and market intelligence services, specializing in regulatory compliance, ESG, governance, financial crime compliance, legal, and risk management. And with us today, we have the firm's founder-director, Ian Morrison in London, and Raoul Montgomery, a research consultant with the firm in its Hong Kong office. Ian possesses over 18 years of executive search and market intelligence experience in Europe and Asia, having placed legal, compliance, and financial crime professionals at the vice president, managing director, and partner level globally. He's worked with many of the world's leading investment banks, asset managers, hedge funds, law firms, and corporate clients. Prior to establishing Arian House, Ian spent 3 years running the Asia-Pacific business for Lethwaite International. He holds a degree in history from the University of Newcastle in the UK. Raoul Montgomery joined as a research consultant in September 2019, and he focuses on APAC markets. He joined from the University of Hong Kong, where he graduated with a Bachelor of Arts degree in Politics and Public Administration. Having worked with a number of NGOs, he is currently pursuing a law degree, specifically a JD degree here at HKU, and he's also fluent in English, Hindi, and Spanish. And with that, I will turn over to our guests. Gentlemen, thank you so much for joining us.
Well, thank you so much for having us on, Ajay. It's an absolute pleasure. Once again, just going back to some of the incredible names that you've had on your podcast over the last couple months, for us to be invited on is clearly a sign that we must be doing something right. So we're very grateful for the platform.
Well, I forgot to mention you and your colleague Kirsty were on back in February to give us a sense of things around about the Chinese New Year time when people job hop. But I guess what's interesting now is that they are starting to formulate some sense of if they are going to hire in the remaining months of the year, decisions and funding is probably being put together now, or if they're going to hold off on hiring in until the new year and see what ensues then. But anyway, that funding's been put together now, and those decisions are germinating now. So I guess as the summer draws to a close, what hiring trends do you see in the legal and compliance space in places like London, Hong Kong, and Singapore, all financial and corporate hubs?
So far this year, we've done a lot of very exciting work with multinational corporates that are actively seeking candidates who possess a very deep understanding of supply chain regulations that can comply with European standards. Additionally, we've noticed a noticeable demand for professionals within that industry with investigations backgrounds to strengthen their regulatory teams. Another very, very exciting development, which I feel definitely applies more so to, I guess, younger professionals, such as myself, whom are aspiring to enter into the legal and compliance field, is that a significant portion of hiring is being driven largely by Chinese companies that are very much focused on short-term strategic planning. Now, these organizations have been particularly proactive in their legal and regulatory hiring efforts and are in the process of establishing or expanding their offices in Hong Kong, which involves obtaining necessary licenses and so on. This expansion, as such, has definitely created a very urgent need for local and senior compliance professionals to lead these departments. Now, as you can imagine, the shift has definitely increased a demand for proficiency in Mandarin, which, if I were to give a word of advice to young professionals, I would strongly recommend that we sort of make a collective effort to try and pursue, at the very least, conversational fluency or proficiency in that language. I think that'll go a very, very long way.
I think Raoul's raised some good points. This is Ian. I think it's been a really interesting year so far. When we spoke to you in February, we were actually really, really busy. I think post the US election, firms got budget again. They realized where they stood, especially international firms, and started to realize that places like Hong Kong and Asia weren't anathema to the rest of the world, and thought, we can actually build businesses there, and we can actually hire regulatory professionals to ensure things don't go wrong. The summer went really quiet, though. I think everyone decided to have their first summer since COVID. And we saw a lot of people, maybe that was tariff driven, sort of push a pause on hiring. But it's definitely starting to warm up again as people come back from their school holidays. But to answer your question in a long way, areas where we see they may be hiring, anything to do with insurance, anything to do with crypto, anything to do with family offices, private wealth. And I think that's globally. People are looking to enhance their regulatory risk functions. Consulting firms are looking to hire senior professionals who can advise on solutions around financial crime, sanctions, anti-bribery. It's not the biggest amount of hiring we've seen in a while, but there's definitely things happening.
So is most of the hiring in the financial realm, or is it multinational corporates more generally?
I think you can break it down a bit further than that. I think multinationals are definitely looking at things like their supply chain risk. I think with the Ukraine war, with the war in Israel, I think people now are starting to look at where they actually source from. We did a piece of work for a huge retail group recently where they were worried that their sourcing locations weren't adherence to popular beliefs in terms of, they've got to make sure that they're not using sweatshops, they're not actually using people who have been incarcerated to actually make the cheap t-shirts or trainers that we receive in the UK. So it's fascinating. Banks are definitely quieter. I think investment banks are probably going to reduce compliance departments by about 30 to 40% and rely more on technology and AI. But then people like areas like insurance are definitely growing. Crypto's growing. So answering your question, it's probably mixed. There's hiring happening, but it's not in the traditional investment banks.
Yeah, it's interesting to hear you say that. And so, Raoul, did you want to chime in?
Yeah, I mean, just to expand exactly on what Ian said, specifically with regards to crypto and the digital asset space in Hong Kong in particular, the Hong Kong's recently sort of enacted stablecoin ordinance definitely does represent a very significant milestone in the city's ambitions to become a virtual asset hub. It definitely signals a degree of confidence in the market. And having worked very closely with exchanges in the past, we definitely expect Hong Kong's crypto sector to adapt their internal controls, due diligence, and monitoring mechanisms to meet rising expectations, which will be remedied by very, very proactive recruitment strategies. We definitely anticipate exchanges to continue prioritizing hiring experienced professionals, ideally with interdisciplinary skill sets, so as to address potential interoperability with varying global regulatory frameworks across the world. And given that it's an up-and-coming industry, it's a very, very exciting place for young professionals and seniors alike. You can't ignore crypto anymore. It's definitely here to stay.
Ian, I'd like to come back to something you said, because while it was troubling that we're going to be cutting compliance departments, that very much comports with what we've been hearing here, that there is either explicit or unofficially a hiring freeze at many banking and financial institutions. They want to keep headcounts lean, and they seem willing to hire at the very senior experience level, but mid to junior level, not so much, and they're in retainment mode. If someone leaves, they're typically not replaced. We're hearing more and more stories of layoffs and hiring freezes in the financial sector. I mean, everyone heard about BC just gutting their geopolitical risk unit, and people like Steve Vickers issued a paper recently saying other institutions must not follow suit. That in your desire to cut, don't cut the functions that you will need in the coming years.
I think just briefly on the HSBC thing, I spoke to the previous member of that geopolitical risk team. It was a bit clickbait in the press. I think HSBC actually have just moved geopolitical risk into a different area of the bank. They haven't cut their geopolitical risk. But going on to compliance departments, reducing in size, they are reducing in size. I think 3-4 years ago, we hit peak compliance. I think people saw huge increases in compliance departments. HSBC, for example, had circa 5,000 professionals dedicated to regulatory risk functions. It was too much, I think, and problems were still happening and issues were still happening. I don't think you can just throw bodies at it. I think the purpose now is to see how much more can we put into the front line in terms of the front line taking more responsibility for patrolling themselves. You're seeing a lot more outsourcing of more sort of menial tasks to low-cost locations. You're seeing a lot more use of technology. Do you need to have 300 people doing monitoring when you can have an AI bot that does all that monitoring for you? You'll still need people, but a lot of the manual work can be done by technology and AI. And I think banks are generally a lot more compliance and aware of compliance and regulation. A lot of the remediation has been done as well. So do you need to have hundreds and hundreds, if not thousands, of people in compliance and financial crime roles? Probably not. But there is still hiring at the top, because you do need highly professional and highly experienced professionals who can actually decide where to outsource or where to bring in AI or where to bring in technology or where to potentially merge departments. You're seeing it some of the investment banks, the compliance and financial crime have been merged into one team. Compliance got very siloed where people were doing very, very specific roles. I think now, you're seeing the rise of a multifaceted compliance and financial crime officer who can do several different roles as the regulatory burden reduces slightly. But then I've said this before, I've been doing this job for nearly 20 years, and every 5 years, I kind of think that compliance departments are going to get smaller. Then something happens, whether it's COVID, a GFC, or a mortgage-backed securities problem. A big problem emerges and compliance departments grow and grow and grow again. So
I guess some functions you've got to have. Look, compliance is mandated by the state. You've got to have it.
Yeah.
Tax, you've got to have it. They save you money. You can't do without sales and operations. Yep. But coming back to the whole thing about political, geostrategic, political risk, whatever one chooses to call it, that's seen as, I kind of think that's seen as optional, even though if they were smart, they'd realize we're entering a riskier world with sanctions, Iran sanctions, North Korea, problems with Ukraine and Russia, that
it's crucial.
In terms of the flavors of risk, and we've discussed this on this program before, that increasingly geopolitical, geostrategic risk is something that's ought to be part of every compliance officer's remit. It's part of their concern. They don't need to be an expert on it. They need to be, have to have international relations or strategic studies level expertise. But it's one more thing they have to be cognizant of.
And I think the front office needs to be cognizant of it as well. I know of one bank, I won't say who, but just in case I betray his trust, but their head of geopolitical risk actually goes to meetings with the front office to present to the clients, which is a long-only clients or hedge fund clients. His job is to actually give a picture of what are the geopolitical risks that could affect their trading strategies. So, geopolitical risk is not just, protecting the bank's integrity. It's actually a method by way in which the bank can actually make money.
Good way to look at it.
Well, I think now if you're an investment bank, especially, your job is execution services. You're providing the best way to execute on behalf of your clients, and highlighting the risks and the potential pitfalls of certain trades. And if they're thinking of trading in a certain jurisdiction or a certain area which has geopolitical uncertainty, which in itself prevents provides opportunity, I presume. It's important you have someone who is an expert and can tell you about the opportunities, the risks that are prevalent in that area.
So are these trends, these trends, and I put this to both of you, the trends that you're describing, you've seen them across the board in London, Hong Kong, and Singapore, or do the markets differ here and there in terms of what's being sought?
That's a good question. I've spent a lot of time in London recently. I come to Hong Kong 3-4 times, well, a bit more at the moment, a year. I've definitely seen Hong Kong has got busier, but then Hong Kong was pretty dormant sort of just after COVID, for reasons we all know. Hong Kong's definitely seen as a location where people want to move to. London's gone quiet. I think, we're in a new government who are rightly or wrongly taxing us a lot, making a lot of investment into public services, which is good. And people are very much wait and see in the UK, but I think people realize that London is a very safe environment and it's a place where people want to live. And we have a stable government now for the next 4 years. Whether it's the right or wrong one, who knows? And I think hiring is going to continue in London. Whether compliance hiring is going to boom, I think it's going to continue the trend of people will look at the new profile of a chief compliance officer and assess whether the incumbents are the right people, or do you need someone who's more savvy with things like AI, geopolitical risk, etc. Singapore, I personally think missed a bit of a trick when COVID hit. I think they managed to attract a lot of people from Hong Kong, and they managed to hire a lot of people, but it seems now that they're being almost what's the word? A little closed to the outside world all of a sudden. And the market there seems very quiet. And it seems to be a focus on Singaporean jobs, Singaporean people, which is understandable as well. A lot of expats are leaving, and I can give probably 10 cases of senior compliance professionals that went to Singapore during COVID that want to come back to Hong Kong now.
Well, thing was that many Hong Kongers, once they hit 50, they're thinking, under Hong Kong law,
Yeah.
because a lot of the corporates follow the government's lead on this, it's retirement at 60.
Yep.
And they're like, no, I want to work until 65. I can use that extra income in retirement. And so they start, people in compliance and legal, once they're in the mid 40s to early 50s, they start looking for roles in Singapore because they want to work until 65, and that's something else to factor in.
I don't know how easy it is for someone to get a job.
Damn near impossible.
But I have seen, it's not a closed shop. I have seen people in their 60s get senior compliance roles in Hong Kong and stay in those jobs. I'm trying to work out how old the two people I'm thinking of, at least 65.
Are they being as contractors or?
Yeah, they'll be on a fixed contract.
Yeah.
Often in 1 to 3 years. But it's still happening and you can still do it.
Last question that I put to both of you, and it goes to, beyond just having a legal credential, beyond just knowledge of the rules and regs, whatever segment of the financial world or whatever type of corporation one may be in, what are the soft skills that in-house and general counsel and compliance need to possess? Because we're seeing a lot of people go on for credentials, and that's a good thing because learning is an ongoing process. You don't want to get too stale in your knowledge or too set in your ways, and so people are going on to get those credentials in AI and machine learning, and the ACAMS, AML credential, the Certified Fraud Examiner's credential, and the crypto investigators title, and all of that. And I guess that's a good thing. But is that's more industry specific learning? What more do they need to bring to the table? Because I know, Raoul, you're taking Mandarin lessons, which I think is fabulous, because that is the direction of things. But what do they need to do? I mean, they need to know what's going on in their industry. They need to have language skills, but what else do they need?
That's actually an incredibly interesting question and is very, very topical moving forward, specifically within regulatory and legal hiring, as I think soft skills are probably now more important than they have been in an incredibly long time. I mean, to start off, the ability to articulate and summarize the integration of functions, specifically RegTech and FinTech, as well as the benefits and importance of these emerging technologies, is increasingly vital for hiring teams. Financial institutions across the spectrum are gradually shifting away from siloed operations towards more integrated frameworks that necessitate a degree of cross-functional expertise. So with that in mind, legal and compliance professionals who can effectively collaborate across different functions are going to be in incredibly high demand. So I believe both, and this applies certainly both for executives as well as young professionals, moving forward, the regulatory and legal space are going to be seeking out candidates who can strike a balance between IQ and EQ. I mean, to put it simply. The shift also, I believe, underscores the importance of building very strong relationships within an organization. In-house lawyers and compliance officers are going to have to work very, very closely with various teams, making interpersonal skills essential for fostering trust as well as teamwork. I mean, now in light of this, effective communication skills are paramount, which is, again, factors into why I believe Mandarin skills are definitely something young professionals should look towards. Legal and compliance professionals are going to have to be faced with, particularly given the emergence of AI, conveying complex legal and regulatory complex to non-legal stakeholders, and in doing so, foster understanding and collaboration across departments. So the ability to critically analyze issues and develop practical solutions is absolutely essential, as professionals moving forward are going to encounter very unique challenges that require both creative as well as strategic thinking. So I think in summary here, and adaptability is key, especially over the last few years with emerging technologies. The fields of compliance, law, and regulation are continually evolving, and that's incredibly exciting. So as such, professionals have to be prepared to adapt to these new regulations, technologies, as well as market conditions. Flexibility, as well as a willingness to learn, are amongst the many, many crucial soft skills that candidates should certainly look towards cultivating. Of course, you have a few arguably more obvious soft skills, for lack of a better word, which include a very, very keen attention to detail, as well as strong ethical judgment. I don't think regulators and lawyers can sort of survive without those two key pieces of criteria. Precision is paramount in these matters, and professionals have to demonstrate meticulous attention to detail to ensure that they can effectively mitigate risks.
Yeah, I think to summarize what Raoul said, I think the key thing I hear from my clients is they are getting a lot more pressure. If you're a chief compliance officer or a general counsel in-house, you need to be able to articulate the risks that the board need to be aware of in a succinct and coherent way. You can't just write an email. You've got to be able to present and talk. And those risks are everything from the traditional risks to newer risks like geopolitical risks and AI. But you've got to be able to communicate and be able to summarize and be succinct.
Well, we'll have to end it and be sure to have you on, certainly, but if not by the end of this year, early in the new year. Gentlemen, thank you so much for your time.
Thank you so much. Really enjoyed it.
Thank you so much.
And we'll be right back. And we're back. Joining us now is Lotte Schou-Zibell, formerly of the Asian Development Bank, to discuss the importance of financial inclusion and sustainability, including her thoughts on how something is seemingly mundane, at least in Asia, as the bamboo plant, can be part of the solution. A little bit about our guest. As mentioned, she was previously with the ADB as a finance sector advisor. Lotte is a veteran international expert on sustainable finance, digital financial innovation, and financial inclusion. She's played a key role in shaping policies and leading initiatives addressing emerging challenges in capital markets and financial systems. For close to 2 decades, she's held various leadership positions at the ADB, including serving as an advisor in the Finance Sector Office, as Regional Director for the Pacific Liaison Coordination Office, and as Chief of Finance. Before joining the Asian Development Bank, she served as Director for International Economic Policy at the Swedish Ministry of Finance, and has held positions at the Swedish Financial Supervisory Authority and the Swedish Central Bank. She's also worked as a consultant at the International Monetary Fund. Lotte holds a master's degree in economics from Lund University in Sweden and a bachelor's degree in international relations from George Mason University in the US. Her career reflects a deep commitment to strengthening financial systems and fostering economic resilience on a global scale. And with that, Lotte, thank you so much for joining us.
Thank you for having me.
So you've got such an interesting background. I mean, tell us a little bit about yourself, where you're from, where you grew up, and just your background in general. I mean, you're Swedish. You went to George Mason, which is known for having a bit more of a libertarian, free market bent in the greater DC area. I'm just curious to get a sense of the path you had, wherever you want to begin.
Thank you. Yeah, so I am Swedish indeed, but I have spent just about nearly half of my life overseas, over 31 years overseas. That kind of exposes my age as well. But in the early 70s, we moved to the West Indies with my dad, and I think that's kind of where my interest in development kind of started. We lived on a little island called Grand Turk in the Turks and Caicos Islands, and it took 2 hours to drive around it. And later we had 2 different stints in the U.S. First couple of years in Virginia Beach, and then later on in the Washington D.C. area. So so I did get to really improve my English skills at the time. Yeah, so after a couple of years, 9 years in the U.S., we came back to Sweden. I went to University of Lund and later on London School of Economics for a year. So that whole international experience has kind of shaped my interests in my profession and also my interest in different countries. And I think the meeting with people has always fascinated me, and hearing people's stories from different parts of the world is quite fascinating.
Well, I mean, I'm sure you've heard of the archetype of Davos man, the truly, international individual who crosses borders with ease and is plugged into global finance. And it would almost seem as though that archetype applies to you. What drew you to the IMF and the Asian Development Bank?
So it's a good question. So, growing up overseas and studying international relations, I was early fascinated by global development, of course. And in the 1980s and 1990s, I was quite intrigued by the so-called Asian tigers, South Korea, Taiwan, Hong Kong, and Singapore, and then how the rapid transformation through industrialization, investment in education, export-led growth, how that really helped shape the region. And then how countries like Malaysia, Thailand, Indonesia, Philippines, and Vietnam, they kind of followed similar paths. But it also showed vulnerabilities, how rapid development could lead to financial crisis. And we saw plenty of that in the late 1990s with Thailand, Indonesia, South Korea, Malaysia, Hong Kong, and then the spillovers across the region. And then, this was also time that I embarked at my career at the Riksbank, the Swedish central bank, and both at the Riksbank and the Supervisory Authority, I was very much involved in financial stability related issues. So helping develop risk-based supervision, macroprudential analysis. I was very much involved also in the financial crisis in Sweden in the early 1990s. So I was working with the then Deputy Governor, Stefan Ingves. He was later the central bank governor. We were a group of people doing the calculations on which country or which banks should be nationalized and which should be closed and so on. So that was quite exciting. It was a real learning curve.
That was through the Asian financial crisis?
Yeah, so at the Asian financial crisis, that was actually after the Swedish financial crisis. The Swedish financial crisis was 92, 93. So that was a huge, it was a had a huge impact on the Swedish economy. So it was an exciting time to be working on financial stability related issues. And yeah, so during this whole time at the Riksbank and the Supervisory Authority, I was starting to track, developments in international organizations like the Bank for International Settlements, the European Union, but also more and more the multilateral development banks and IMF and the World Bank. And this interest just kind of drew me to the Asian Development Bank. I think when I became director for international economic policy at the Swedish Ministry of Finance, it's kind of when my interest for Asia and development there kind of aligned more with my day-to-day work. And it also exposed me more to the work of the Asian Development Bank in the region. So when I had an opportunity to join ADB 2 years into my role as director at the Ministry of Finance, I really didn't hesitate. I relocated with two young children and their dad, and we moved to the Philippines.
It's always struck me as a challenge of developmental economics that, translating, theoretical economics is the way people have been taught about in the West, and applying that to practical, tangible, real world solutions on the ground in the developing world, particularly Asia, the Middle East, Africa. And you've run the ADB financial sector development projects now for about past 20 years. I mean, what are the biggest changes you've seen, and what would you regard as your greatest achievements during your tenure?
Well, I think the past 2 decades has been quite fascinating. The global financial system, it's really gone through a huge transformation. And just a few days ago, I was looking at the latest global FITEX data, and about 79% of adults globally, they now have a bank account. And that's a big jump from just 51% in 2011. And, in the low and middle income countries, over half adults are now making payments from an account using either a mobile phone or a card. But at the same time, we still have a long way to go. So poor adults, they're still less likely to have access to financial services, and about 1.3 billion people worldwide still don't have an account. So that's kind of a reality check. You get excited about the progress, but you kind of have to stay grounded and see that there's just still a lot of work to be done. But looking at the changes that have been taking place, I think digital transformation is probably the most visible change. Mobile money, fintech apps, blockchain, and also open banking are really reshaping how people use financial services. And we shouldn't forget the impact of COVID-19. It's kind of a period that you try to block out of your mind. But the pandemic really accelerated financial inclusion as everything moved online. There was a surge in digital payments during this time. In Pakistan, for example, the government issued biometric and mobile-enabled rails to deliver, I think it was over 200 billion rupees to families during lockdowns. And in India, UPI usage it doubled. And you see similar developments across not just Asia Pacific, but across the world, that digital payments really picked up during this period. And of course, there's been a growing focus on financial inclusion, not just reaching more people, but reaching women and MSMEs. And you've seen a development in digital ID, eKYC, alternative data. And of course, now the conversation is evolving from access to finance to financial health, much thanks to Queen Maxima and her efforts at the UNSGSA. Of course, climate and sustainability have entered mainstream finance. ADB, as you know, is now a climate bank. ESG frameworks, green bonds, sustainability-linked loans, they're now key tools for managing long-term risk and driving responsible investment. And of course, after the global financial crisis in 2008, regulations that became stronger, capital requirements, AML safety rules, and macroprudential oversight. And we've also seen the rise of RegTech, SupTech, and help regulators and banks manage compliance more efficiently. And of course, the big topic today, which is the more recent one, is how central bank digital currency, and especially AI, is reshaping the financial system. So these innovations are really redefining, or have potential to redefine, everything from cross-border payments, monetary policy, and capital markets. So just looking back, I think in a hope I helped shape some of the shifts at ADB. I think I managed to do at ADB. I introduced early thinking around digital finance and mobile money, and helped pilot the first cloud-based core banking system in the Philippines and with the rural bank in Mindanao, and also launched Asia's ADB's Asia Finance Forum in 2016. And this actually continues to this day. So I continue to remain engaged in this, and it's been an incredibly rewarding.
So you're essentially a consultant now with the ADB. I mean, how's that working out? I mean, working with people that you know, but in a perhaps less formal, official capacity. You know how it is that sometimes when relationships become more intermittent, and I guess that's just the nature of life sometimes. But what's it like? I mean,
I think
being
it's actually
being part of the organization, but kind of being on the outside.
Yeah, no, it's actually working out really well. I thought I was going to have a little bit of downtime after I left in February, but activities have taken off pretty quickly. So I think consulting, it really gives me the best of both worlds. I get to stay engaged with financial sector issues that I care deeply about, while also having more flexibility. I'm collaborating with many of the same colleagues and teams, which makes the transition seamless. But now I can focus more on thought leadership, innovation, solution design, particularly in areas like fintech, sustainable finance, and digital infrastructure, and also mentoring, which I really enjoy. And, most importantly, I can work remotely from Stockholm or wherever I happen to be, which allows me to take on other advisory roles and projects that I'm passionate about. And after 30 years overseas, it feels pretty good to be back in Sweden, especially as both my children are here. They're grown now, but and I even enjoy the winter months, even if it gets dark. I miss the changing seasons after so many years in a tropical climate like the Philippines. Fall is already kicking in here in Stockholm. Yeah, so on the whole, I think it gives me space to keep learning and contributing in a meaningful way.
It's interesting to hear you say that, because I know with many Western expats, even after their contract ends and they're formally quote unquote retired, they still choose to remain in Asia or the Middle East, and continue to do other things. Either start their own businesses or consulting work, and they say going back to the West, it just doesn't feel like home anymore, or they return for visits, but it doesn't. It makes sense, right? If you've been in a place for long enough, that starts to feel like home. But I want to turn to one of your ADB website posts entitled, quote, "5 Ways Bamboo Can Revolutionize Finance, Housing, and Sustainability." You stated, quote, "Bamboo's fast growth and carbon capture abilities offer a sustainable solution to financial inclusion, housing affordability, and economic resilience in developing countries. Integrating modern technologies with bamboo cultivation can drive economic development while mitigating environmental impacts." I mean, being here in Hong Kong, I mean, bamboo is ubiquitous. We see its utility in construction. It apparently can be woven into any number of garments, woven into fibers, which can be used for myriad uses. But again, I can see the benefits for sustainability in the environment, but perhaps housing and for finance, is that a little overreach, or you firmly think that's the case?
A fair question. So I could agree. At first glance, linking bamboo to finance may seem like a stretch, but it's actually quite grounded. So I'll just provide some context to explain a bit how it holds up.
Please.
So at ADB, about a year, maybe 15 months ago, so it's quite new. We started looking at for a solution to provide affordable, sustainable, and disaster resilient housing to underserved communities, especially in disaster prone areas such as in the Philippines. So when we were searching for a solution, we discovered this incredible potential of bamboo. And it's a grass, it's fast growing, carbon absorbing, and when treated and processed, it can be turned into construction materials that are durable as steel, much as you mentioned. But I think the real breakthrough, what made me really interested, was when we saw that bamboo roots were in some plantations being geotagged. And this opened up the dimension of data. So, by leveraging technologies like geotagging, geospatial mapping, artificial intelligence, we started realizing that bamboo can generate alternative data that could actually revolutionize how farmers and financial institutions interact. And such data points, they can help financial institutions assess the value of bamboo assets, predict future revenues, and evaluate collateral for loans. So, in other words, bamboo could become a financial asset. And such data could also enhance risk management, create new investment opportunities, create an ecosystem where bamboo is valued not just for its environmental impact, but also for its economic potential. And of course, beyond numbers, growing bamboo can generate green jobs, resilient businesses, and sustainable livelihoods and better financial health for rural communities. So now, kind of to answer your question on finance, so first, bamboo can be monetized for example, carbon credits, climate-linked bonds, and sustainable value chain. Its high biomass yield, it can and rapid sequestration rates can make it ideal for carbon markets, which in turn can open up new financing channels such as green loans and results-based climate finance. And in other areas of bamboo cultivation and processing, it can create micro small enterprise opportunities across rural communities. This includes nurseries, craft production, housing supply, construction material, and of course, and in turn, then when bankable and formalized, these enterprises generate demand for credit. And third, because bamboo can be grown on degraded or disaster affected land, and because its use cases span from housing to construction to textiles, paper, it allows diversification of income streams. So for lenders, this lowers portfolio concentration risk, especially in climate vulnerable areas, and it increases the case for climate adaptive lending. And then and then with digital technologies like blockchain, geospatial verification, IoT sensors, bamboo plantations, and value chains, they can be fully traceable, which makes them suitable for tokenization or securitization. And then finally, of course, governments can integrate bamboo into national development and green growth strategies. And this opens a door to performance based budget support, climate financing, and cross sectoral investments that blend public and private capital. So, no, I don't think it's overstating the case. We're just starting to connect the dots between environmental assets, inclusive finance, and climate resilience. So this concept from root to revenue, where the root is the asset, is about turning bamboo into a secure, bankable, tradable asset so farmers can earn more, lenders see real values, and communities get stronger homes and livelihoods.
Oh, certainly. And if they can pull it off, I mean, I think we should all laud ecological capitalism, the functioning of markets. In another ADB website post entitled, quote, Banks Without Borders, How AI, IDs, and Innovation Are Changing the Game, you wrote, quote, rising compliance costs, regulatory fragmentation, and de-risking are limiting cross-border banking access, but technology-driven solutions offer a path to restore connectivity and resilience, end quote. Now, this is something that's always been of interest to me, given my AML background. I guess what I'm wondering is, how do you solve such an entrenched problem? Because regulators say banks should adopt a risk-weighted approach to compliance and not engage in wholesale de-risking. Yet, correspondent banking and related AML KYC issues for certain sectors is a perennial issue. I mean, and frankly, de-risking occurs because the compliance cost for banks to maintain correspondent banking relationships with certain categories of customers is just too dear, given the small profit from serving them, because either the enhanced risk associated with serving a particular class of client or the customer's business volumes are too small. So again, it's an entrenched problem. How do you get around that? Because it's ultimately it's about the economics of maintaining a particular relationship with with the bank. For the bank, it's about the economics of maintaining a relationship, particular category of customers, and it's all well and good for the Basel Committee or the G20 or the World Bank or the IMF to say, or regulators to say, adopt a risk-weighted approach, but they're gonna hedge their bets. They're gonna play it safe. So that's why you're seeing wholesale de-risking.
Yeah, you're absolutely right that de-risking, and just to provide a definition for those who are not quite sure what it is, it's where global banks withdraw from correspondent banking relationships due to, for example, high compliance costs and regulatory uncertainty. And it is so this
Thank you.
de-risking is not just a regulatory compliance issue, but it's an economic one. And the cost of due diligence combined with limited transaction volumes and perceived risk make it rational, though deeply problematic, for banks to exit certain relationships. So basically, when the cost and complexity of compliance outweigh thin margins, banks pull back, especially in small markets and higher risk sectors. So again, just to provide a bit of context, de-risking is not new. So interestingly, over the last decade, the global volume and value of cross-border payments increased by 61 and 37% respectively. And while these cross-border payments rely on correspondent banking relationships, Pacific Island countries have seen at the same time a 60% decline in correspondent banking relationships, which is double the global reduction of 30%. So as you kind of alluded to already, on strengthened or stricter requirements, about 20 years ago, correspondent banking was common even among smaller banks because of lower compliance requirements. But following the global financial crisis in 2008, stricter regulatory and enforcement requirements has tightened anti-money laundering regulations, increased tax transparency, applied more effective economic trade sanctions to detect and also deter criminal activity, and also to reduce the costs of future systemic financial crises. But for many correspondent banks, it has proven challenging to meet these new regulatory, supervisory, and capital requirements. And in addition, many developing countries, they have small and resource-constrained regulatory agencies and face difficulty keeping pace with evolving international standards. So this poses a question on the future of the correspondent banking model. So it's complex, it's multifaceted issue that really requires new thinking. So just a few thoughts on this. The World Bank, through its specific strengthening correspondent banking relationship project, was approved in 2024, if I remember correctly, is, for example, looking to identify a service provider that can offer correspondent banking services to eligible financial institutions if the participating Pacific Island country loses its CBR in a key currency. ADB is working alongside the World Bank and is supporting CBR-related issues, for example, AML, CFT risk assessments, improving legal frameworks, establishing digital infrastructure. ADB is also deploying a regional AI-based platform to compare regulatory frameworks in the Pacific against partner economies. And this is to guide necessary reforms and enhancements to their AML frameworks, to start with at least, because AML CFT is one of the key risks in compliance in the region, or perceived risk. So just coming back a bit to your question on these technology-driven solutions and how they offer a path to restore connectivity and resilience. And one such technology, as I kind of alluded to before, is AI-powered analytics. So we can take Reg Genome, for example, a spin-off from Cambridge University. And this is a platform for regulatory framework analysis. It uses AI to read regulations from different jurisdictions, transform unstructured and semi-structured text into structured, searchable, and analyzable data. And this kind of approach allows regulators and market participants to compare legal regulatory frameworks side by side, identify gaps, overlaps, and inconsistencies. And the aim is really a more consistent, objective view of how international standards are applied to attain greater transparency, better evidence for policy changes, and lower compliance costs. Another interesting solution, which is, been developed by Augustin Carsons and Nanna Nilikani, is the Finternet. And these are tools that are kind of new and up and coming, but I mentioned you have to kind of start looking at new solutions, and I'm sure there are lots more. These are just two examples. So just like the internet connects different websites, the Finternet aims to connect different financial networks such as banks, payment apps, and governments so they can work together. So the philosophy is that even the simplest payment or transfer, they still run through a maze of intermediaries, which makes payments slow, costly, and still unavailable in many parts of the world. So the Finternet, what they're proposing is a shared digital infrastructure that puts users at the center of their financial lives. And just like the internet made it possible to share information seamlessly, the Finternet is designed to let people and businesses move anything of value with lower cost. So these are new emerging technologies. Among many others, they have potential to enhance regulatory compliance, mitigate risk, provide much needed transparency, and offer a pathway to restore and strengthen correspondent banking relationship issues. So de-risking is indeed real, but you can fix it by lowering the cost of certainty, better identity, clear rules, and interoperable rails.
Certainly for me, I've been a AML CTF. It's been a field of interest to me for really basically since 9/11, and really once that happened, the Patriot Act was passed, and you had Section 312 and its implications for correspondent banking and how it amended the older 1970 Bank Secrecy Act. The writing was on the wall for correspondent banking. And now I'm thinking it would be a shame to drive people away from mainstream, conventional, legitimate banking, but water finds its own level, and it's not inconceivable that as they've ratcheted up controls in mainstream conventional banking, that some people are going to find their way into the shadow banking system. And a related note, as mainstream banking has gotten tougher in terms of compliance, you're seeing a lot more cheating on the trade-based money laundering front.
Yeah.
So people find other avenues, but on the tech front, there's also the issue of basic infrastructure being lacking in many emerging markets, as we've discussed, and the biometric safeguards are just not there in the developing world. Many don't have ID cards or smartphones. Does the developing world simply have to provide aid, or for the developing world to catch up? And I guess on a related note, should we regard India's Aadhaar card as a triumph?
Yeah, so good point. So just to kind of unpick this a little bit. So first, with regard to places with weak infrastructure, for example, no smartphones, biometrics, and so on, you actually don't need to start with everything. So countries that can phase in foundational ID, basic verification services, allow tiered KYC, and then on your question on so you can kind of start with that, and then you can build toward digital public infrastructure such as digital IDs, open APIs, and shared payment rails. So then this kind of leads into your question on Aadhaar, if it's a triumph or not. Yes, I think Aadhaar has been an operational success at scale and the clear proof that digital biometric ID can reduce KYC costs and expand access. And while I'm not entirely on top of how many other countries are adopting Aadhaar-like API ID programs that banks can use for KYC verification and so on, I understand countries like Philippines, Pakistan, Indonesia, Bangladesh have similar systems in place, which are, of course, adapted to their respective legal and social contexts. And then on your question, if the developed world has to provide aid, well, in my view, yes, but I'm of course biased, having spent my career in development and poverty reduction. There are 10 multilateral development banks in the world. The World Bank and ADB are two of them, and they play a crucial role in helping these developed markets build the systems they need. So both these systems, much like many other multilateral development banks, are focused on ending extreme poverty, expanding shared prosperity globally for the World Bank, across Asia and the Pacific for ADB. So on correspondent banking, I think the answer isn't more rules, but better plumbing. So this includes shared infrastructure, aligned standards, practical innovations that reduce compliance costs while still protecting the integrity of each country's financial system and also the global financial system. So development aid is what helps pay for helps pay for and de-risk those upgrades, especially in small markets that can't shoulder the cost alone. So development aid can basically pave the way for more sustainable private sector development and investments as well.
You know, what struck me about one of your other posts, a more recent one, which I think the title was Strengthen Compliance to Safeguard Pacific Banking Access. You said, quote, addressing gaps in financial compliance, upgrading digital infrastructure, and improving regulatory capacity can help Pacific countries build economic resilience and protect vital financial links. I guess this ties in with what we were saying about increased compliance costs for AML, KYC, and CTF. That are we not in a state of compliance overkill? I mean, many bankers are grumbling that most of what they do these days is compliance rather than the real business of banking, that they say banking is no longer fun. Are we overdoing it with compliance? And or is that just the face of things to come? That's just the world we're living in, because, well, obviously there has to be a limit to it, because otherwise it undercuts the economic rationale for being in business if compliance gets too obscene. By the same token, many of these compliance rules are well intended on a principle based basis. I mean, they're well intended, but they have unforeseen consequences, and it's people on the ground that end up having to suffer because they have to implement them. Your thoughts?
Yeah. This kind of ties back into also our discussion on technology. So I think the shorter answer is that it's not more compliance, it's smarter, cheaper, and more consistent compliance. So banks actually can spend more time banking. In the Pacific, for example, compliance costs are very high and markets are small. So the practical fix is to close specific AML safety gaps and strengthen supervision. Here you can use these AI platforms for comparing legal regulatory frameworks across jurisdictions, identify gaps, and then know exactly where to fill the gaps and what areas to strengthen. The other is to upgrade digital rails such as foundational ID, KYC, straight through reporting. Here you have these alternative rails such as the Finternet and the likes, and then share costly utilities across countries so each bank doesn't have to rebuild the same controls. So these are more like digital public infrastructures. So this is all things that are these technology solutions I think can help resolve some of these issues. But the combination raises assurance while lowering unit costs, which is what is needed to keep correspondent banking links open. So the goal is really not to pile on rules, it's to streamline essentials and share infrastructure, thereby cutting the cost and uncertainty while also preserving vital financial links for small economies. So safeguarding access, it means building trust, and trust comes from transparency, capacity, and systems that work. And that's where development partners, technology, and leadership actually come together.
To your point about not having each bank recreate all the controls and that having it be like a public infrastructure, the thinking was on that point that blockchain would be a panacea, distributed ledger technology. Everyone would have access to it. It would lead to transparency in the banking sector. You could see who had too much debt on their balance sheets, which institutions were over leveraged, and they could be told, okay, you need to unwind some of your trades. But increasingly, what we're seeing is no, they don't want that for the industry. Every institution wants its own private closed circuit
Yeah.
blockchain.
Mm,
And if there are any cost savings, I doubt those savings are going to go down to go to the consumer.
mm.
And that what was intended to benefit consumers and society at large, I don't know, somehow the institutions have just found a way to siphon off the benefits for themselves. And well, what are your impressions? That sometimes technology doesn't help society at large as much as it does institutions that it was designed to I don't know, thwart or get around.
Yeah.
I mean that was the debate amongst the Bitcoin blockchain purists in the beginning, and those that said no, you've got to make the moderates wanted accommodation, and said you've got to get the banks on board. The anarcho-libertarian idealists said no, don't get the banks on board. They'll find a way to twist it and contort and corrupt it for their benefits. What do you think?
Yeah, as on the blockchain, I think it hasn't really delivered what it was hyped up to be, and maybe 10, 15 years ago when it was first coming out. It's still under development. You can't have the volume of transactions just doesn't meet what, for example, Swift can do on a daily basis. But things are still kind of under development, and that's why I'm kind of trying to wrap my head around these solutions where you develop alternative payment rails, and to be quite honest, it's quite technical, and a lot of it's beyond my own capacity, but I find that quite promising, that it could potentially be promising to identify these alternative payment rails and to develop these digital public infrastructures. It's not easy. Several years ago, ADB, World Bank, IMF, several Pacific Island countries, Reserve Bank of Australia, New Zealand, were all working together to develop a regional eKYC platform for the Pacific. And so we were working on this for a year and a half or 2 years, and at the end, it was just as you mentioned. It was decided to go. Each country wanted um, their own solution, but there was a lot of learning in this, a lot of sharing of information. So even though you may have your own solution for your country, it can be a similar approach, and you can use potentially APIs to kind of link them together. And if you have different blockchains, for example, if you develop them in such a way that there can be linkages between them, I think that could be a potential future solution as well. I think there's this, it's evolving so quickly. So we just have to keep learning and keep our eyes open for potential solutions, because on this specific correspondent banking relationship issue, apparently the current solution isn't really working as it should. So we really need to think a little bit outside the box. So, I don't have, all the solutions, and I don't think anybody does. We're all, it's a whole community working together to try to figure this out. The World Bank is of course, have a huge project on this, and I'm looking forward to see how that pans out, and also the work of ADB and other developing countries. The de-risking issue is across the Pacific, it's across Africa, it's in many countries.
Lottie, in the time we've got left, is there anything that you'd like to say? Any last words? Anything you feel we didn't quite cover?
No, I think this technology is fascinating, and it has really transformed the financial system in a major way in the past 20 years, as we discussed before. And I think that pace of change is just increasing. And I find it difficult to keep up with everything that's happening and all the new legal regulatory frameworks, their digital assets and their open banking, and there's so much going on. So it's yeah, so it's great to be able to talk about it and to vet ideas. There's a lot of learning to be done. People have there's a lot of information out there, lots of great ideas, We just have to hone in on it and try to come up with some concrete solutions that actually solve the problems for the people that are most affected by it.
Lotte, before I let you go, you have an event coming up, and that is technology is a key theme you're organizing for the ADB. Could you tell us a little bit about that?
Yeah, so the Fifth Asia Finance Forum, which I'm still supporting in a consultant capacity now, is coming up very soon. It's the 23, 24, 25 September, and it will take place at ADB headquarters in Manila in the Philippines. So do keep your eyes out, or do look it up. It's the Fifth Asia Finance Forum, and the theme is positioning for the future. And what makes this event unique is that, unlike many other these financial technology events, this event is really focusing on ADB's 43 developing member countries. So they're bringing in and actually sponsoring up to 3 people from each of these countries to come to ADB for a whole week, so they can learn directly from experts. And all the presenters that are there, they're carefully vetted so that we know that they can speak to the needs of the developing member countries and explore solutions that can meet their needs. So the conference is focusing on, the first day is on sustainable finance, catalyzing sustainable finance and green finance and so on. And the second day is more on financial inclusion, financial health, and the third day is promoting the use of digital technology. So it's a broad range of stakeholders, including policymakers, private sector, academia, non-government organizations, and I think there are about 450 people coming. At least 90 are sponsored development member people from ADB development member countries. So it's to be really very highly interactive event. It's not your normal panel discussions, but there are parallel sessions and very interactive. So people are not going to go there and just sit there and listen. They're going to have to be very active themselves. So I'm really looking forward to it, and do look it up. It's on Development Asia, Fifth Asia Finance Forum, Positioning for the Future.
Lotte, thank you so much for your time.
Absolutely.
And to our listeners, thank you again. Until next time.